In this session, we'll focus on exotic options. Probably you might have heard of the word exotic in various scenarios, not necessarily in the world of options. Wherever we use the word exotic, we generally refer to the plain meaning as non-normal, non-standard. Those are the ones we call as exotic products. So the same thing, at least from a broad overall perspective, gets applied even to exotic options. In general, we have normal plain options like your American or European options. These are typically categorized as plain vanilla kind of options, or probably any other derivative instruments which are traded very plainly on the exchanges, like your regularly traded futures or the regular deals on the OTC market, which include forwards and swaps with very regular features among the various participants. All those things will get considered as plain vanilla derivative products, whereas anything which a firm is using any combinations or any specific hedging model a firm is using, which cannot be replicated or which cannot be created by the various existing plain contracts, right? If at all, okay, the company has to hedge a portfolio X and it is not able to find a suitable combination of contracts either on the futures market or on the European or American exchange, American options market, or in the regularly available forward or futures market. So let's say such kind of regularly available combinations are not suiting the purpose of hedging for a particular company. It can think of getting into an exotic options or exotic derivatives contracts with its client, creating positions more or less on the similar lines of the hedge or of the underlying position which it is having. So if at all a hedging position is created in a customized manner based on the risks associated with the portfolio of that particular firm, we are calling those kind of derivative contracts as exotic derivatives. So probably because of less liquidity, more customization, what you would find is if at all we are doing the pricing of the exotic options, we have to be very careful, because there are a lot of challenges as far as assessing the cost of it, what is the current market value of it, because it's not frequently traded, and how do you determine the payoffs, or what is the mechanism or the duration or the timing of payoffs for these contracts. All these things have to be carefully studied and understood in order to get into a exotic derivatives kind of a contract. But if that is the case, why do companies look at using exotic derivatives? One straightforward benefit, as I have already indicated, they help in hedging the firm's underlying assets in a very unique manner. Probably a kind of a customized hedging is what they can very comfortably do. That's one of the prime motivators to get into exotic derivatives, but at the same time they can do this for speculating purposes or for taxation and regulatory reasons. But some of the things which every organization has to comfortably understand is have a thorough understanding of the payoffs. It could include the timing of the payoff as well as the amount of payoff. Understand the payoffs in detail and also the credit risk involved, because they are not exchange traded kind of contract. So understand the credit risk involved in the entire derivatives transaction, and based on that do the pricing, because generally you are taking more risk, so you have to be compensated with more benefit. That will definitely be existing, but it should be in proportion with the amount of risk that you are taking. So a risk adjusted return determination can be done only if you can understand the payoffs as well as the credit risk involved in these transactions. Then see whether your organization or you yourself can estimate the costs correctly, the costs of creating an exotic derivative product. Do you have the pricing models which could monitor the value of the non-traded derivatives over time? Because these are all illiquid, very little trading available on them. So is there any kind of a mechanism to understand the pricing behavior of these derivatives? And there is a possibility that most of these derivative contracts will have some penalties or probably large bid-ask spreads. So do you have any mechanism, or are there any pricing models or mechanisms available which can help you in understanding when to reverse the position after taking into consideration all these penalties and bid-ask spreads and all? Is there a possibility to reverse the position to get a profit, or under what circumstances the positions can be reversed? All these things are very challenging when you go ahead with exotic derivatives products. So the companies need to have a proper pricing models as well as the clear-cut understanding on the behavior of these various exotic derivative products. And in this context, we need to understand that whenever we are trying to create a hedging portfolio, some of the most important concepts that we need to look at is, can we convert our derivative into a zero cost product? What do you mean by zero cost? Most of the times we create packages. What are these packages? We include some, as a part of our portfolio, we include some options, forwards, cash, underlying assets, lot of these things. Now we create some long positions and some short positions in all these things. Especially in case of options, when we create long positions, we are paying premiums, and when we create a short position, we are receiving premiums. So I create a long and a short position in such a way that whatever I receive today is offsetting whatever I have to pay today. In that case, today it's a zero cost position for me. So if I can create the option positions where the cost incurred for me is zero today, that is where we are probably over various time point, we can very well say that particular scenario as converting a derivative into a zero cost position, wherein at any stage where cash inflows match with the cash outflows, we are calling it as a zero cost product. So one more thing is, whenever we talk about exotic options, there is a starting point which says converting a normal standard American call option to a non-standard. What does it mean? Typically, if you understand the process of American call option, it is nothing but you can exercise the option at any point during the maturity period. Let's say I have taken an option on this date, call option on this date, or put option on this date, and this is the expiry date. I can exercise the option at any point from today till the expiration date. That is the regular behavior of a regular standard American call option. Whereas if I put a few restrictions saying the exercise cannot happen like this, but exercise can happen at only some predetermined points, then you are converting a standard call option into a non-standard one, standard American option into a non-standard one. This kind of option wherein you can do the exercising only at a specific points in time over the duration, over the life of the option, but not any time whenever you want, we call such kind of options as Bermudan option. A Bermudan option is a general extension of an American option or a restriction of an American option where you can exercise only at a few points in time, few days, on a particular few days. Probably if the option is a 3-month option, probably you exercising only at the end of every 1 month. You have an option to exercise the option. You can exercise your option at the end or expire it at the end of every month. And so it's not a European option that you can exercise only on at the end of the 3rd month, and at the same time it's not an American option where you can exercise whenever you want. There are a few points of exercising during the life of an option. Those kind of options fall under Bermudan options. Or sometimes what I can say is I can put a lockout period. You cannot exercise for the first 1 month. After that, it becomes just like an American option. You exercise whenever you want. But there is a lockout period that for the first initial period, there is you cannot exercise the option. This is also one way where you can convert a standard American option into a non-standard one. Sometimes what we can say is, at different exercise prices or at different layers of maturity. So this is probably a 3 months to maturity, this is 2 months to maturity, this is 1 month to maturity. At different points in time, you change the strike price. So it's not in a typical regular American option, the strike price is common across the entire maturity period. So here in this kind of an option, I can play with different strike prices across the different maturity levels. So what we are trying to say in this entire scenario is, I can create my own options as a variation to a standard American option by playing around with the exercise points, exercise dates or whatever, and the strike prices. By doing some kind of a playing around with these things, I can convert a regular American option into a non-standard one. So they are all exotic options for us. So if we see, we will go ahead looking at some of those category of exercise option, exotic options. How I can play around with the exercise dates, as well as the number of exercises, as well as the strike prices, to create some exotic products. Okay, some common types of exotic options that are available in the market. One is a forward start option. This is more like this. Okay, a 3-month option is not getting effective from today, but after 6 months. After a certain point in time, the option gets into existence, but we are getting into it today itself. So these kind of options are called forward start options, wherein the option is not starting on the day we are getting into a contract, but it is getting started at some forward date. Generally, the most common example in this scenario is an employee stock option. Let's say the employees are given options provided they stick to the company for 6 months, which could be their probation period. So the employee stock option plan, whatever has been specified, it starts after the probation period, which means it does not start immediately on the date of joining. Which means, what would be the price of the option? I need to know what is the price of this. This is nothing but the price of the equivalent European put option or European call option. The price of equivalent European call option on a non-dividend paying stock with the same 6 month or with the same forward start period as the expiry period itself, because during this time the option is nowhere exercising. This is the only thing is the option will come into existence only when the employee is with the company for the first 6 months. Otherwise, it will expire. This is what is a forward start option, which could be an exotic option itself. Then we have chooser option. Let's say an option is having a 2-month expiry period, but it is giving me a flexibility that after 1 month you can choose whether you want to go for a call option or a put option. So I am giving an option wherein you can decide whether you want to convert it into a call option or a put option somewhere during the life of the entire option. So depending on whether the call option is carrying more value or put option is carrying more value in on this decision taking date, I will choose whether I should go for a call option or a put option. This is another kind of an exotic option that is prevalent in the market, which is the chooser option. Then we can even talk about exchange options, which is an option to exchange one asset with the other. Probably, I can buy, let's say pound with rupees, exchanging pounds for rupees or exchanging gold for silver. I have an option to exchange one asset with the other. When will I do that? When I am very much sure that I am getting more value with the one which I am receiving compared to the one which I am paying, I will definitely get into this exercise this option. Otherwise, I will not. So these kind of options where I am exchanging one particular asset with another, we call them as exchange options. The most common categories get into stocks and currencies completely. The other typical kind of options which get in this scenario are a basket option. Sometimes people also call them as rainbow options, because many securities are combined together and it's an option to buy not just one single security. Option is not to buy one single security or one single asset, but it is always applicable on the entire portfolio of securities or assets. That is why we call this kind of options as basket. These are all not available. It's not the same as Index options. Index is also on a basket of securities, but that is decided by the exchange and that is actively traded on the exchange. But if I go with some stocks, an index and a currency, all such kind of different kinds of securities together, create my own basket or a package, and then start trading with the other counterparty, that is where we are referring to them as rainbow or exotic kind of options. Alright, then we also have another good category of options, exotic options, called compound options. It's a kind of option on an option. So there is an option that is being given today, whether you want to buy the call option or expire. So let's say, when I say call on call, right, if we understand one, we can get a clarity there. If I say call on call, I have an option to buy a call option probably after 3 months. So when will I buy this call option? If I typically see that the benefit from this call option, the value of this call option, right, see, this is an option to buy a call option on this day. If I have to buy a call option on this day, the value of this call option, the intrinsic value as well as the premium, which I determine using, let's say, the Black-Scholes model or any model, the premium of this option on this day should be less than the market price on this day. Only then I will go ahead with, or should be more than the intrinsic value of the option on this day should be more than the market price of it. That is where I will prefer going ahead with this option. So, but to decide whether to go for that option at a future date or not, I am taking the option today. Those are called as the compound options. So basically these compound options, they have a defined period. This defined period, so it's basically like, it will be like this: a 3-month compound option for a 6-month call at $100. So it is more like I am taking a decision to whether I should go for a 6-month call option for $100. I am not deciding on it today, but I am deciding on it 3 months later. So I need to know what is the premium associated with this, right? So we always have 2 strike prices. One is this 100, and one is the price at which we are buying this particular call option. Even I can choose what price I should buy, what should be the premium that I should pay for this call option. That also becomes as another strike price. It's like this. Okay, let me put it slightly more clear. Let's assume today is 1st Jan. There is an option on 1st April to buy the stock, let's say on 1st October, right? So the stock, so this option is primarily a 6-month option to buy the stock at $100 on 1st October. This is an option for that. Now as far as this option is concerned, it's a 3-month option to buy this option at a premium of $2. right? So this is how a compound option looks like. So on 1st Jan, I'm just paying some premium. I have to decide what should be the premium, just like any other option pricing formula. But on 1st Jan, I am getting into an option which will tell me whether I can buy a 6-month call option on April 1st to buy the security at $100 and the option premium at $2. So on that day, if the option premium is more than $2 for the 6-month $100 option, I will exercise this option which I have taken on 1st Jan, otherwise I will expire it. So one thing we have to understand as far as these exotic options are concerned is we will have two strike prices. One is the strike price of the underlying, and one is the strike price which is associated with the premium that needs to be paid to acquire the second option. And also we have two maturity dates. One is for the underlying, which is 1st October, and one is for the call option, which is the 1st April itself. So the combination of these two things, value of the underlying option, this, which in turn is decided by the value of the underlying asset, is what will decide the value of the first option as on today. These kind of exotic options are typically classified as compound options. Then we also have another set of exotic options called as shout options. It's a very interesting option. Okay, this, let's assume that this is the life of the option. This is the date on which you have purchased an option, and this is the expiry date. For this shout options, what happens is the buyer of the option, he can choose one date within this entire period. Let's say he has chosen this date. Now what is happening is, whatever is the intrinsic value of the option as on this date, whatever is the intrinsic value of the option as on this date, for a call it is S minus X naught, S naught minus X, whereas for a put it is X minus S naught. Whatever is the intrinsic value of the option as on this date, this amount is locked. Means the payoff will contain minimum of this amount. The intrinsic value, so the payoff in case of a shout option is the maximum of either the shout intrinsic value. So one single shout date is chosen by the buyer of the option contract. So he will, based on the date he has chosen as the shout date, generally only one date is allowed in this regard. So based on the date that is chosen as the option shout date, whatever is the intrinsic value of the option on that date versus what is the intrinsic value of the option on the expiration date, which is nothing but whatever is the market price minus the strike price on the expiration date. Out of these two, whichever is the maximum, that is what is being paid to the party. So you are basically locking the amount that you can receive on the expiry. Even if the market price falls, in case of a call option, even if the market price falls after the shouting date, you will receive your shout intrinsic value. But if the market prices rises, then there is not much of a difference between the typical European call option versus your shout option. But only when the market price falls after the typical shout date, that is when there is a lot of advantage going ahead with the shout option. Alright, let's move on to the next one. The another set of important options are the barrier options, slightly different from the European option. See, in a regular European or an American option, what do we say? For a call option, the market price greater than the exercise price, the difference between the two is being paid as a payoff. And for a put option, if the market price is less than the exercise price, the difference between the two is paid as a payoff. Now here the scenario is slightly different. We have the typical terms as knockout or knock-in options. 1. 2. The exercise price is different from what we call as barrier price. There is a difference between these two prices, the exercise price and the barrier price. So what we said is, okay, today the stock price is something here, let's say 100. So there could be two barrier prices. One is, let's say, 120, the other is, let's say, 80. What we say is this barrier is called as a higher barrier. Means the barrier is set at an amount greater than the current market price. So we call these kind of barriers as higher barrier or up barriers. These kind of barriers are called higher or up barriers. Whereas if a barrier is set at 80, which is below the current market price, we call those barriers as down barriers or probably lower barrier. That's one thing. Now, then we also say whether the option is out or in. What does that mean? If it is out, so means up and out. We use words like up and out barrier. What does that mean? If at all this upside barrier is reached, the option is out. Means the option expires. The option expires, the regular option expires once. The regular option will definitely have a strike price, but that regular option will expire in case the barrier is reached on the upward side. Similarly, if there is a down and out barrier option, it means the option will expire if the market price touches 80. As long as it is above 80, the option will still continue. But if the market price touches 80, the option will exit. Similarly, we have in category options, up and in. What does that mean? The option will actually start existing. The option will come into existence only if the market price touches 120. If the market price does not touch 120, it's an expired thing itself. As long as the market price does not touch 120, the option does not come into existence at all. Similarly, down and in option is also like that. As long as the market price does not touch 80 on the lower side, the option does not come into existence at all. So this is a very typical kind of exotic option, slightly complicated, and even the regular characteristics of typical call options or put options are slightly deviating between the regular options as well as this kind of exotic option. One thing is Vega, see, which is an indication of the change in the option price with respect to volatility. And our common understanding is, as the volatility increases, we say that the option premium increases. In a regular call option or a put option, we say, it's a very common understanding for us, that as the volatility of the option increases, the premium of the call option typically increase, because the chances of exercising the option, whether it is call or put, will actually increase. But in case of barrier option, especially that involving out, especially those involving out, up and out or down and out kind of barrier option, what you will see is, as the volatility is increasing, the chances of as the volatility increases to a certain level, the chances of exercising the option are higher. But once the price crosses the barrier levels, we see that the option actually expires. So the chances of expiring the option will increase, which means the price of the option should come down beyond a certain volatility level. Up to a certain volatility level, probably the price of the option may increase with the volatility, but beyond a certain point, I see that the price of the option will decrease with the volatility, because once the price crosses a certain barrier mark, either on the upward side or on the downward side, we see that the chances of expiring the option are increasing rather than exercising the option. So, which is a clear-cut indicator that there is a possibility of negative vega in case of barrier options, especially which are involving out, whereas in any traditional option we say that the vega is always positive. So that way what you could see is the typical characteristics of the options also differ significantly as far as the barrier options are concerned. Right? This is one important characteristic that is worth understanding as far as the barrier options are concerned. Similarly, we have the scenarios of binary options. As the word itself is saying, binary. Only two possibilities. Or here we call them as only two payoffs. Either some amount, so which is like either a fixed amount or nothing. So what is that fixed amount? We have two different models for this. So whenever, probably if it is a call option, right, in a regular option, what are we saying? Market price greater than the strike price. The difference between the market price and the strike price is the payoff. Whereas in case of exotic or in case of binary option, call option, it becomes, if the market price is greater than the strike price, some X amount is paid, and if the market price is less than the strike price, nothing is paid. So there are only two payoffs here. The difference is not the payoff in case of binary option, it's only a fixed payoff once a particular exercise price layer is crossed. Right. So in this fixed or nothing, there are three forms. One is one people call as cash or nothing, or we have asset or nothing kind of models. So in cash or nothing, a fixed cash is paid in case the market price is greater than the strike price in case of call, or vice versa in case of put. A fixed amount is understood, is agreed upon at the beginning itself, and that amount is paid. Whereas when we are talking of asset or nothing, initial value of the asset is paid once the price crosses something, otherwise nothing is paid. But in a simple notion, it is straightforward. I need to understand what is the probability that the price crosses a particular amount, and if it is crossing a particular, what is the probability that the price crosses a particular amount, a strike price, and the present value of that. So typically when we are going with a Black-Scholes model, we can very well value a cash or nothing call option using this particular formula. Whatever is the fixed amount into E per minus RT, which is the present value of that, multiplied by N of D2, which is nothing but the probability that the stock price crosses the strike price. The same thing is going ahead with your asset or nothing kind of a call option. Then we also have another category of options called lookback options. This is a very interesting option, which is probably, if this is the life of the asset, right? In this life of the asset, what we are looking at is we identify the minimum as well as the maximum value of the asset during this period. So for a call option, the difference between the exercise price and the minimum price is paid, which means it is giving the buyer a flexibility to buy at the lowest possible price during the life of the option. It is allowing the buyer of this look back option to buy the underlying at the lowest possible price, because the payoff is nothing but exercise price minus the minimum price. Whereas in case of a floating rate, floating look back put option, the payoff is the difference between the maximum price during the life of the option minus the expiration price. So this here you can easily lock the price of the buying price as well as selling price. In general, the buying price is the minimum most price of the asset during the life of the option, whereas the sell price is the maximum price of the asset during the life of the option. And in some variants, you could, instead of putting a floating look back, you can even go for a fixed look back. So what happens during this fixed look back is you are setting some exercise price somewhere. You are setting some exercise price X. So the payoff will be for a call. The payoff will be the maximum price minus the exercise price. Whereas in case of put, it is the exercise price minus the minimum price. So this is the way a look back option will work. Well, the only thing is these options will really help you in going ahead with your trade with the minimum most and the maximum most value of the asset during the life of the option. That's the advantage. But remember, all these options, though they are giving you these kind of benefits, there is a premium associated with each of these options. You have to use models to identify what should be the appropriate premium to price these kind of options. That's the one important aspect to be focused on, right? Then we also have another category of exotic options called Asian options. So instead of they focusing on the expiration price, one single price, they actually focus on the average price during the life of the option. That is what we call as those kind of options are called Asian options. Instead of looking at one single price where there is a possibility of very good volatility and fluctuations, we focus on the average price during the life of the option, either the average asset price or the average strike price. We have two different forms of Asian options, wherein we talk about average asset price during the life of the option, or average strike price during the life of the option. So in case of when the payoffs are being decided, we talk about the average asset price. In case of average price options, the comparison is between average asset price or average underlying price and the exercise price. Whereas when we talk about average strike price options, the comparison is between the expiration price and the average asset price. So average asset price is a more important consideration here, and because we are not depending on one single value, we are depending on an average of values, the volatility is expected to be much lesser. The average anyhow will pull down the volatility. So the volatility of an Asian option is always expected to be much lesser compared to an equivalent European or American call option, and that itself will translate into lower premiums in case of Asian options. But one thing is, we need to know what kind of average is being generally followed. I can very well go with the Black-Scholes or any such kind of option pricing models in case the geometric average is being used for the average asset price. But if the arithmetic average is being used, then probably I may have to go with, this makes the model slightly complicated, but still what I can do is, I can assume that the returns, that the asset prices are following a log normal, because if I go with the geometric mean, then probably I can directly go ahead with the log normal model. But if I am taking the arithmetic average, then I am presuming that the log normal distribution exists, and I am making a kind of an assumption and going further, because otherwise it will complicate the model use. But in general, if at all the geometric averages are typically used, there is no issue with using the option pricing models for pricing the Asian options also. Then in this context, apart from looking at the various types of exotic options, we also need to focus on other types of instruments that are generally based on the volatility. The most common instrument that we see based on the volatility is the volatility swap, wherein a swap is created between two parties on some notional principle. One party pays an amount based on assumed volatility or based on fixed volatility, which is determined as a part of the contract, whereas receives the payment based on actual volatility on some notional amount. They are all remaining the same. So pays an amount based on a fixed volatility and receives an amount based on an actual volatility. So here the underlying price and all do not matter at all. The only betting is on the volatility of the underlying itself. Similarly, we can also talk about variance swap. Instead of just taking the volatility, we talk about the volatility squared, which is nothing but, because generally volatility is measured in terms of standard deviation. So when I talk about a variance swap, the same kind of a swapping, but instead of volatility, which is the standard deviation, I take the square of the standard deviation and do the cash flows exchanging based on the variances. But it is understood that it's very easy to price and hedge the variance swaps, because the portfolio can easily be replicated by collections of calls and puts. Because in general also what we see is, we can add the variances of the individual securities, but we cannot add the standard deviations of the individual securities, right? So whenever we talk about finding the overall variance, we can add the individual variances, but if I have to find out the overall standard deviation, first we find out the overall variance, and then we take the square root of the same, which means they are not directly sub-additive, whereas at the variance level I can do a sub-addition. They are not additive, whereas at the variance level I can do a simple addition. So that's the reason a variance swap hedging is quite more comfortable compared to a volatility swap hedging and pricing, right? And if at all we are talking about hedging exotic options, before hedging itself, we need to understand that some options like Asian options are very easy to hedge because the volatility is much lesser for them, and as they approach quite closer to the maturity, the average prices is more or less a reflection of the market price. So hardly we find too much of volatility, so hedging can be more easy. Even when we are going with a dynamic hedging, the costs involved with the hedging will not be so heavy when we talk about an Asian option. But when it comes to a barrier option or any other exotic options, it's not so easy. The simple way to create a hedging position is nothing but replicate a portfolio which is exactly opposite to that of the position of the option. That is something which we have been understanding as the meaning of a hedge. You create a portfolio which is using any instrument. You create a portfolio using any instrument whose characteristics are more or less similar and opposite, exact and opposite to that of the underlying exotic option position. Sometimes you can create these portfolios on a static model as well as on a dynamic model. So what do you mean by dynamic model? You are changing the composition of the portfolio quite often. So if you are changing the composition of the portfolio quite often, means you are involved heavily in the trading process of those constituents of the portfolio, which can increase your transaction costs and all. Whereas there is a static option replication process, static replication of the portfolio, replicating the underlying option position, wherein you create a portfolio of completely actively traded options whose positions are more or less similar to your exotic option scenario. So we are almost, while creating, we are looking at actively traded options which by themselves adjust their values with respect to the changes in your exotic options. So you are in fact you are not incurring heavy transaction costs. So more or less the position replicates the underlying exotic option position, which is a very good mechanism of hedging your exotic options altogether, right? So in this as a conclusion thing in this particular chapter, our focus was majorly on the need for exotic options and various types of exotic options that are available in the market. What are the different characteristics of each of those exotic options, and finally how would you getting into the hedging of exotic options. If you have any further queries regarding the same, you can feel free to get back to me by giving me a call on this number that I have provided here, or you can even send in an email at vamsidhar@pacegurus.com. I request you to visit my website www.pacegurus.com for further updates regarding the training and consulting services we offer in the areas of finance and analytics. Thanks a lot for listening to this session. Thank you very much.